What is a 401k plan? Hi, it's Luigi, and welcome to Catapult Capitalism, your guide in making smart financial moves for your future. If you enjoy watching our videos, feel free to like, subscribe, and hit that notification bell so you get updated whenever we upload a new video. In today's video, we'll be tackling the ins and outs of a 401k plan. So if you like these kinds of videos, stay tuned. What is a 401k plan, and how does it work? A 401k is a retirement saving and investing plan provided by companies. Employees who contribute to a 401k plan receive a tax credit on their contributions. Contributions are deducted automatically from employee paychecks and invested in funds selected by the employee from a list of available offerings. The annual contribution maximum for 401ks is $20,500 or $27,000 for individuals 50 and over. When an employee enrolls in a 401k, he or she agrees to have a portion of each paycheck deposited directly into an investing account. Part or all of the contribution may be matched by the employer. The employee has the choice of selecting from a variety of investment alternatives, most of which are mutual funds. The catchy name derives from the portion of the tax code that introduced this form of plan, the subsection 401k. Employees contribute to an individual account by enrolling in automatic payroll deductions. The tax reduction occurs either when you contribute money or when you withdraw it in retirement, depending on the type of plan you have. A lot of companies can provide you with a 401k, but unfortunately, not all jobs can give you access to it. Individual retirement accounts, the second major retirement savings fund, can nevertheless provide you the same tax advantages. All of this may prompt the natural question: what exactly is an individual retirement account? Individual retirement accounts, or IRAs, are tax-advantaged savings accounts that people can create to save and invest for the long term. An IRA, like a 401k account that is provided as a benefit by an employer, is intended to encourage people to save for retirement. Anyone with a source of income can create an IRA and benefit from the tax advantages these funds provide. Here's how a 401k varies from an IRA, and if applicable, how to use both simultaneously. Many employers offer to match a portion of what you save. If your workplace offers a dollar for dollar or 50 cents on the dollar matchup to say 6% of your contribution amount, stop reading right now and sign up. If nothing else, contribute enough to your account to qualify for the free money. This is a good opportunity to point out to you that there are various versions or types of 401k plans, including the two most common: traditional 401k and Roth 401k. The traditional 401k provides an immediate tax advantage on your investments. Contributions to a Roth 401k are made after tax money, so you cannot deduct the money from your taxes for that year. But don't worry, the Roth will pay off eventually. A defined contribution plan is an alternative to the typical pension, often known as a defined benefit plan in IRS parlance. A pension is a commitment by the company to provide a set amount of money to the employee for the rest of his or her life during retirement. 401k plans have been increasingly widespread in recent decades, while conventional pensions have become rare, as businesses have moved the burden and risk of retirement savings to their employees. Employees must also pick particular assets for their 401k accounts from a menu provided by their company. Typically, these programs contain a mix of stock and bond mutual funds, as well as target date funds designed to decrease the risk of investment losses as the employee approaches retirement. Guaranteed investment contracts, or GICs, provided by insurance firms, as well as the employer's own stock, may also be included. The maximum amount that an individual or company may contribute to a 401k plan is increased on a regular basis to account for inflation, which is a metric that monitors an economy's growing costs. Employee contributions are limited to $19,500 per year for workers under the age of 50 in 2021 and $20,500 per year in 2022. Those aged 50 and older, on the other hand, can make a $6,500 catch-up payment in 2021 and 2022. There is a total employee and employer contribution amount for the year if the company additionally contributes, or if the employee elects to make extra non-deductible after-tax payments to their standard 401k accounts. Employers who match employee contributions utilize a variety of algorithms to determine the match. For example, a company may match 50 cents for every dollar contributed by the employee, up to a specified percentage of pay. Take note that for 2022, employee-employer contributions cannot exceed $61,000 per year for workers under the age of 50. The cap, including the catch-up payment for people over 50, is $67,500. It is impossible to withdraw money from a 401k without paying taxes on the withdrawal amounts. Make sure you have adequate outside savings for emergencies and needs that may arise before retirement. Don't put all of your money in a 401k where you can't immediately access them if needed. Earnings in a 401k account are tax-deferred in standard 401ks and tax-free in Roth 401ks. When a typical 401k owner withdraws money which has never been taxed, that money is taxed as regular income. Owners of Roth accounts have already paid income tax on the money they donated to the plan and will face no tax on withdrawals as long as certain conditions are met. When an employee leaves a company where they have a 401k plan, they generally have 4 options. Withdraw the money. Withdrawing money is typically a terrible idea unless the employee is in desperate need of cash. The funds will be taxed in the year they are withdrawn. Unless the employee is over 5,912, totally incapacitated, or meets the other IRS qualifications for an exemption to the regulation, they will be subject to the extra 10% early distribution tax. Something to take note of, however, is that the regulations on this might have changed because of the COVID-19 pandemic, so it's probably a good idea for you to do more research about it. Roll your 401k into an IRA. By transferring the funds to an IRA at a brokerage business, mutual fund company, or bank, the employee can avoid paying immediate taxes and keep the account tax-advantaged. Furthermore, the employee will have access to a broader selection of investment options than under their employer's plan. Leave your 401k with the old employer. Many businesses will allow a departing employee to maintain a 401k account in their former plan permanently, even if the person can no longer contribute to it. This generally applies to accounts with a minimum value of $5,000. As for smaller accounts, the employer may force the employee to transfer the funds elsewhere. Leaving 401k funds in place makes sense if the previous employer's plan is well managed and the employee is happy with the investment options available. Employees who move jobs throughout their careers may leave a trail of prior 401k plans and may forget about one or more of them. Their successors may similarly be ignorant of the account's existence. Move your 401k to a new employer. Generally, you may transfer your 401k balance to your new employer's plan. This, like an IRA rollover, keeps the account tax-deferred and avoids paying immediate taxes. If the employee isn't comfortable making the financial decisions needed in administering a rollover IRA and would like to delegate part of that work to the new plan's administrator, this might be a good step. The most straightforward approach to beginning a 401k plan is through your workplace. Many businesses have 401k plans, and some may match a portion of an employee's contribution. In this situation, the firm will handle your 401k paperwork and payments during onboarding. You may be qualified for a solo 401k plan, also known as an independent 401k plan, if you are self-employed or manage a small business with your spouse. These plans enable freelancers and independent contractors to fund their own retirement even if they are not employed by another firm. Most internet brokers can help you set up a solo 401k. So, did you learn something? Were you enlightened by these 401k facts? Let us know in the comments section. That's it for today's video. If you enjoyed this video, don't forget to like, subscribe, and hit that notification icon so you can be notified whenever we upload new videos. Thank you so much for tuning in to Catapult Capitalism, and we'll see you later.